If you had invested just $5 a day 10 years ago, you could have over $22,000 today without touching a single risky stock. The problem? Most people never take that first step. They believe investing is too complicated, too risky, or something only the rich can do. But the truth is, you can start small and still build real wealth over time. In this video, I'll show you a simple, step-by-step plan to start investing, even if you're a complete beginner. Welcome to CoinCraft, from zero to investor, where we learn how to make money work for us, one simple step at a time. I'm not a Wall Street pro, but I've done the research so you don't have to. This is a beginner-friendly space for anyone who wants to build wealth the smart way. Here's the simple truth. If you only save money, you're actually losing money over time. Why? Inflation. Let's say your savings account gives you 0.5% interest per year, but inflation, the rising cost of goods, is 2 or 3%. That means your money is shrinking in value without you realizing it. The way to fight inflation is to invest in assets that grow faster than it. Historically, the U.S. stock market has averaged around 10% annual returns before inflation, or about 7% after inflation. That's way ahead of what a savings account can offer. Before investing a single dollar, you need to understand the three main types of investments. Stocks. These are pieces of ownership in a company. If the company grows, your stock value usually grows too. Bonds. These are loans you give to companies or governments. In return, they pay you interest over time. Funds. These are bundles of many investments in one package. Index funds and ETFs are the most popular types for beginners. Here's the good news. You don't need thousands of dollars to begin. Even $5 a day can grow into a significant amount over decades, thanks to compound growth. For example, if you invest $150 a month at an average return of 7% after 30 years, you'd have about $183,000, and you only invested $54,000 of your own money. That's the magic of compound interest. Your money earns money, and then that money earns even more. For most beginners, the easiest place to start is with an index fund or an ETF. These are collections of hundreds of companies, so your risk is spread out. Take the S&P 500, for example. It holds 500 of the biggest companies in America, from Apple to Coca-Cola, and has delivered about 10% average returns for decades. Sure, the market can go up and down in the short term, but over time, it has a history of growing. The best way to invest consistently is to automate it. Set up an automatic transfer from your bank to your investment account every month. This is called dollar-cost averaging. It means you'll buy more shares when prices are low and fewer when prices are high, without ever trying to time the market. Over time, this smooths out the ups and downs and keeps you on track. Starting is the hardest part, but it's also the most important. Begin small, stay consistent, and let time do the work. In the next episode, we'll break down the magic of compound interest so you can see exactly how your money grows while you sleep. Hit like if you found this helpful, and subscribe so you don't miss episode 2.